Here we are, Chapter 20 of the Ross Fundamentals of Corporate Finance text, and this is the 9th edition thereof. We're talking about credit and inventory management in this chapter. So, credit and inventory management, and we're going to see that just like chapters 18 and 19, we are going to talk about, well, essentially carrying costs versus shortage costs. So we'll talk about ways that firms manage their accounts receivable and some information about their credit policies. We'll talk about how they structure the terms of a sale, in particular credit sales, because we're talking about credit policies and accounts receivable here. We'll talk about the factors that influence the firm's credit policy, decision to grant credit to particular customers. We'll talk about how to evaluate credit policy, and here we'll actually do some calculations of the benefit of issuing credit for a one-time purchase, and then we'll talk about the benefits of a repeat customer, and actually developed a formula to determine the relative value of those two kinds of customers. Then we'll talk a little bit about inventory and inventory management systems, and talk about the optimal inventory level. We'll use the economic order quantity model to determine the appropriate reorder point for inventory. So you may have talked about that in your operation management course if you've taken one. Otherwise, this may be fairly new to you, but it's not particularly complex. So if you like bullet point form, there they are. Same things, just in bullet point form. So what exactly do we mean when we talk about credit management, and why would we issue credit? Well, credit management means that we're giving our customers time to pay us, and so they don't have to pay us immediately. So essentially what happens is we make sales for a period of time without requiring them to pay in cash, and then at the end of the period we'll send them a monthly statement or a periodic statement if it's not a month, but most small and medium-sized businesses would use a monthly time period. So we send a statement to tell them how much they owe us, and then they send us one check per month. And since at the time of writing, or at the time of recording this video, it costs about $50 per check that a company writes. It's fairly expensive, so if they were going to have to write a check every time they bought something, it would be quite expensive. So this makes it much more efficient, so they can accumulate their costs into one check and write one check a month. Of course, checks are becoming less and less the medium of making payments between companies, but at this point they're still around, and that's one of the major functions that they're still used for, is for intercorporate payments. We individuals don't tend to use a lot of checks. I've asked to take a brief survey of a few of my classes, and pretty much the only thing that gets paid with a check anymore is rent. Okay, so what are the benefits of granting credit? Well, in general, granting credit means that you can increase your sales, because if you're going to require cash payments only, then some people will go find a competitor that allows them to use credit, and so you may lose sales. Granting credit actually increases the amount of sales that you can do. And the costs, of course, are the fact that the customers sometimes don't pay. You're basically taking them on trust that they will actually pay. And then there's the additional idea that your receivables period will be longer. If it's all cash sales, the receivables period is essentially zero. But if you're going to take longer to collect, that means that you have to finance the receivables and the associated inventory, and so you have to borrow money to do that. So you need to pay a cost that goes with that as well. And so there are costs of granting credit. There are benefits of granting credit, as you probably are expecting at this point. We're trading off carrying costs against shortage costs. So credit management is essentially that trade-off between the benefits of increased sales and the costs of granting credit to our customers. So a few things that you need to know in order to set a credit policy. You need to know the terms of the sale. So the credit period is one of them. You may have seen in your financial accounting course 2/10, n/30. That's the standard terminology for 2% 10, net 30. And that credit period, as you interpret that number, 2%, 2/10 means 2% discount for a 10 a 10-day payment. So if you make your payment within the first 10 days, you get to take 2% off the price. If you don't, then the net balance, the entire 100% balance, is due within the second stated period, which is the credit period. Most small and medium businesses would have a 30-day monthly credit period, whereas some large organizations, large corporations, and government organizations can be 60 or 90 days, or even 120 days for very long credit periods. But typically, 30 days is the credit period. You may establish a cash discount, as I said, so you could actually establish a 2% benefit for paying early, and that's, as we will calculate in a couple of slides here, that tends to be a fairly hefty benefit that you're bestowing on your customers. So the reason you would do that isn't just because you like them and you want to be nice to them. It's because it saves you having to worry about collection, so you don't have to have your accounts receivable clerks or some other credit facility, maybe a credit collection agency, trying on your behalf to collect that amount. So if you're paid early, that problem is gone. There are a number of different kinds of credit instruments. The standard trade credit is just your agreed on ability to, you've given the customers the ability to purchase without actually paying. Usually there's some kind of a document that's required to indicate that it actually has been authorized by the company. The standard item is a purchase order or a PO, they're called. So if you have a PO for the purchase, it's been properly authorized, and so you can grant credit based on that PO number. Excuse me. Credit analysis is trying to figure out which of your customers are actually going to pay and which ones won't, and avoiding the ones that won't. And so there's a number of ways to do that. We'll talk about how we establish good credit versus bad credit. We'll talk about collection policy, and that's the amount of effort that we expend in collecting receivables which haven't been paid on time. So we've seen this picture before. We've talked about the cash cycle and the operating cycle in the previous chapter. And so the idea of accounts receivable, the accounts receivable period is the difference between when you make the credit sale, they owe you the money, they owe you at the time that they're supposed to pay according to your credit policy. So at the credit sale time, they have incurred the liability, and then of course it's going to take some time for them to actually mail the check to you, for the snails to bring it to you on snail back. And so then when you get it, you're going to deposit it into your bank. Your bank is going to send it through the clearing system back to their bank, and if they have cash, it will be transferred from their bank account into your bank account, and the process will be from the date of the sale to when you actually collect the cash and can use it in your bank account. If there's a holding period, of course, that holding period is to allow the proper clearing of the customer's bank account, and so it may be a little bit longer after you deposit it that you can actually use the money. So as I mentioned, you may have seen the form as shown here. That's 2/10 net 45, or just N/45. Indicates you get a 2% discount if you pay within 10 days, and if you wait till the very last moment to pay, you have to pay within 45 days in order to fulfill your contract with us. So an example here would be if one of our customers bought $500 worth of merchandise with those credit terms, they could pay $490, which is a 2% discount. So 2% of $500 is $10. They can take $10 off the price if they pay within 10 days. Otherwise, they have to pay the full $500 if they pay after 10 days, but they must pay within 45 days. So they basically get a 2% discount for paying 35 days early. So they get a 2% interest benefit over a 35-day period. So what is the interest rate that they're earning? Well, it means that they're getting $10 of interest. They're saving $10 of interest. If they pay now, they pay $490. If they pay 35 days from now, they pay $500. So that's the $10 interest period, or interest payment. The period rate is a $10 interest payment on the basis of the $490 that they're borrowing from us, essentially. So $10 on $490 works out to 2.0408%. You can do that math in your calculator if you want to check it. But that's the interest rate that they're essentially getting for a 35-day period. Then of course you have to figure out how many 35-day periods there are in a year in order to calculate the equivalent or the effective annual rate. Remember, we did our in Business 370 we did a little trick with a $1 savings account. So if you put in 365 divided by 35 is 10.4286 periods. When you see that in your calculator, hit the N button. So 10.4286 is N. The I per Y is 10 divided by 490. When you see that in the screen, you'll see it as 0.020408. So you need to multiply by 100. Multiply by 100 and then put that into I per Y. Put $1 in the present value, put 0 in the payment, and compute the future value. You'll see that it's 1.2345. So that's 23.45%. And that's a fairly hefty annual interest rate. So we're giving them quite a benefit for paying 35 days earlier. But of course the benefit not only includes getting paid earlier, it includes the fact that we don't have to try to collect money that we've already received. So that's the reason for this fairly substantial benefit. We can save on collection costs later. Alright, so things that affect the length of the credit period. The perishability of the item. In general, you don't want to have a longer credit period than the item that you sold them will last. Otherwise they don't really have any incentive to pay you other than their personal integrity or their corporate integrity, as the case may be. So it also increases the risk for you if you can't actually go and get the asset and bring it back and sell it to someone else, even if it's in the diminished value. That's kind of bad news. It's actually an interesting program on TV that basically it's a collection agency going out to repossess vehicles that have been sold and have been falling short on payments. So they go out to the customer's house and they put up the car on the tow truck, and so they hook it up and get it all set up, and then they ring the doorbell and say, if you can answer these these 3 trivia questions correctly, you get to keep your car and we'll pay off the loan and you don't have to pay for it anymore. If you can answer them correctly, I think it's like 2 out of 3 or something like that, you get, I think it's 3 strikes you get. So you have to answer, I think it's 5 correctly, and you get 3 strikes. 3 strikes, you're out. Your car's headed down the road. So it generally kind of becomes a big neighborhood thing, and of course they're filming it all, and for us to watch. And it's kind of funny because when they get a wrong answer, the tow truck driver raises the car off the ground a little bit more. When they get a right answer, they lower it a little bit. Kind of a whole big dramatic thing. But if it was groceries instead of a car, of course it would all be gone or spoiled by the time you got out there to collect it. So it wouldn't be nearly as dramatic a television program in that case. So the perishability of items is something to think about when you're setting your credit period. Consumer demand for your product. If there's lots of demand, you're not going to lose much. There's not going to be much lost sales if you don't grant credit to the extent that the customers would like. The profitability. If you're making a lot of money on each individual transaction, you can afford to take a bit more risk, and so it's kind of the risk-reward trade-off. The credit risk, you can actually assess that. We'll talk about that in a couple of slides here, how you actually determine whether a company or even an individual purchaser is worthy of having credit. We'll talk about the size of the account. Larger size, more risk. You would tend to have a lower credit period if it's more risky. Your competition. If your competition is giving credit, then you probably have to as well. In cases where you don't have a lot of competition, you're in a fairly strong negotiating position, and so you may set a shorter credit period. The customer type, you might actually set credit periods differently for different kinds of customers. So if you're selling to the government, you're probably going to have to wait 90 days. If you're selling to the local mom and pop corner store, you can probably require a 30-day payment period because that's what they're kind of used to. So, effects of setting credit policy at different levels. Revenue effects, you're going to have to give up receiving cash, and you're going to have to wait and collect it at the end of the credit period. So of course that's costly, so you're going to have to pay financing costs for that. the fact that you're allowing credit may actually allow you to increase the price, so you can make a little bit more money. Our beloved Edmonton company, the Brick Warehouse, has been taking advantage of that effect for a very long period of time. They tend to charge a little more for the furniture, but they allow, very, very lax credit terms, and they just about sell to anybody who has a pulse. So that allows them to increase the price, and although they're taking some substantial credit risk, it's offset by the return that they've made. And of course, the Comries are doing quite well. Thank you very much. As a result of the Brick Warehouse, it may increase the total sales that you make as well. Once again, also the brick kind of situation. They've established, brick warehouses even in the States. So there's a substantial benefit for allowing credit. The cost of the sale is still incurred, so you still have to pay for your inventory, because you can't think on your customers or on your suppliers, so you need to make sure you pay them, even if you haven't received the cash from the sale yet. And of course, you have to finance the receivables, so you actually have to borrow some money so that you can you can pay your inventory costs and all your other bills before you actually collect the money from your customers. There is some probability of non-payment, and so you need to build that into your credit policy, because it's going to determine the amount that you actually have to pay to recover the non-serviced debt. There may also be a cash discount, as we mentioned, so some customers can pay early and get a benefit. That's often used in credit policy to enhance the speed with which your customers pay you. So here we're thinking about a company, we're thinking about evaluating a switch from a cash-only policy to a net 30 policy, which means that our customers will pay us 30 days later. The price per unit is $100 and variable cost per unit is $40, so we're making $60 contribution margin on each one, as you will be familiar with from your management accounting class, I'm sure. The company currently sells 1,000 units per month, but under the proposed policy, they think we're going to find 50 additional people who will buy from us because of the credit policy. Our required monthly return is 1.5%, which is about 18% per year. So what is the net present value of this switch? Should they actually offer the credit terms as listed? Well, we get an extra 50 transactions with a $60 profit. So that's 60 times 50, $3,000 of extra incremental cash flow. And that's going to be true forever. So that's $3,000 per month extra cash flow. And as we can see here, we're using a perpetuity calculator. So $3,000 is the extra cash flow each month. 1.5 is the interest rate per month, which works out to a value of $200,000 today. So we get an extra $200,000 in our bank account today. Essentially, the value of those future purchases of $3,000 every month is worth $200,000 today. It's going to cost us to switch because our existing 100 customers are not going to pay immediately. Our existing 1,000 customers are not going to pay immediately. So we're going to lose $100 for a month. So essentially that full month of collections is going to be gone, and all of those future purchases are pushed 1 month into the future, which is why it's 100 times $1,000 as the cost of switching. But we also have to pay for the inventory that we're going to build. The existing situation, we have to build $40 inventory, 1,000 units of $40 inventory for our existing customers. But now we actually have to build $40 inventory for the extra 50 customers that are brought in by the credit facilities. And so we have to actually pay an extra $2,000 for that. So we lose $100,000 in our bank account. We have to wait a month to collect. So all of those $100,000 payments are moved one period into the future. So it costs $100,000 immediately plus another $2,000 to build the inventory. So it's plus $200,000 minus $102,000. We're $98,000 better off immediately. So the company is worth $98,000 more by switching to this credit policy. Kind of cool. So to summarize, there are carrying costs and shortage costs, as you might have expected by now. The carrying costs are the required return on the receivables, so we actually have to finance them. So whatever our required return is, we need to pay that interest cost to borrow the money to finance the receivables. We also have to consider the losses from bad debts. If they never pay us, we're out the cost of the inventory, and whatever the cost of managing the credit and collections would be. So that could be either internally, in-house, having our accounts receivable clerk call and try to collect, or having the collection done by a collection agency. We talked a little bit about how we could collect receivables more easily in the last chapter. Shortage costs would be lost sales due to not allowing people credit and they're walking away because they can't pay cash today. So once again, you might expect that we would have a total cost curve, and there might be a minimum point, and there's an optimal credit policy, as we'll see in the next slide. You've seen this slide in each of the last 3 chapters, 18, 19, and 20, where we talk about the optimal amount of credit where we're offsetting the opportunity costs, which we see here. Opportunity costs go down as we allow more credit. On the other hand, so if we have no credit whatsoever, we're giving up a lot of sales. The more credit we allow, the more free our credit policy, the fewer of those lost sales there's going to be. On the other hand, the amount of credit we grant is fairly linearly related to the amount of interest we have to pay. So that's the carrying costs here. And there may be we've sketched it as a carrying, as a linear model here, but some things like the bad debt expense might not be linearly related. They might actually increase as we get more and more credit. So the first, the fairly restrictive credit policies, we probably are restricting it to fairly reliable customers. But as we get more and more credit being granted, is probably going to cost us more in carrying costs. But it's not a bad approximation. If you just have an interest rate that you pay on your receivables balance, it's essentially linear. So anyway, we add these together. So the cost here is going to be the cost of the opportunity cost at this point plus the carrying cost at this point. So that's the total cost. And so we can see that it would kind of go down to a minimum amount in the trough in the valley here. And then as we get out of the optimal area, it's going to start increasing again. So we'd pick a credit policy somewhere here. So how do you decide which customers you're going to grant credit to, which ones are good and which ones aren't? Well, for businesses, we can look at their financial statements. We spent some time talking about liquidity and solvency and those ratios that indicate that. So things like working capital ratio and quick ratios and cash ratios and times interest earned calculations and those kinds of things, your debt equity ratio, those sorts of things, give us some idea of the ability of the company to pay us back. We can look at credit reports from the credit granting agents or the credit reporting agencies. TransUnion and Equifax in Canada are the 2 big ones. You can look at the bank, and you can actually get them to confirm their assessment of the creditworthiness of their customer, especially if they've had a long-term relationship with the customer. You might actually get a letter of credit from the bank saying that if they don't pay you, you can collect directly from the bank. And you can also look at your own individual corporate history with the firm and determine whether or not you have a good relationship with them. If they've paid in the past, they're likely to pay in the future. If they've shirked in the past, they're likely to shirk in the future. And then we can talk about the 5 C's of credit. There are I think 4 C's of diamonds: clarity, cut, carat, and color. I think are the ones for diamonds. Of course, these are different. You can also get a credit score from these same credit granting agencies. If you request, as an individual, if you request a credit report, you'll get a list of all the raw data that they have on you. So all of the credit facilities you had and whether or not you paid on time, whether you committed, whether you've declared bankruptcy in the past, and all those sorts of things are on the credit report. So they're legally required to send that to you. But they also calculate a credit score, which kind of ranks you against everybody else in their database in terms of the likelihood that you have to pay your bills. And so you can get a credit score as an individual. You can also get a credit score for a business. But what are these 5 C's of credit? Well, here they are. There's character, which means are you actually willing to meet your financial obligations? These are usually the ones that we use to assess personal financial planning, personal creditworthiness. So companies don't really have character, but the owners of the company have some degree of character, some degree of willingness to pay their financial obligations as they're due. Capacity means can you actually generate them out of your existing cash flows. So utilities generally have very replicable cash flows, because if you don't pay your utility bill, they'll cut it off and you'll be freezing in Edmonton in the winter, and that's kind of bad news. So you tend to make those payments, whereas service-oriented businesses generally tend to be more of a cash basis, because they don't really have any way of making sure that you can pay your cash. And they also don't have the replicable cash flows that large utilities have. So cash flows are good. If they've got cash flows that are fairly predictable every month, that's a good thing. That's their capacity to make payment. Capital would refer to whether they have financial assets that you can use as credit, or as collateral for your, I guess collateral using that term here, but as security for your for the business. So even if they aren't generating cash flows right now, they could sell some of these financial assets and pay you. Collateral is stuff that they have that you could actually take and you could sell in settlement of the debt. So collateral refers to physical assets, and you can use that as security. And then the economic conditions. There are some times when credit is really easy to get, and there are some times when it's not so easy to get. So 2007 was a credit crisis in the States, and as a result pretty much everywhere else in the world, and that was because the economic conditions weren't conducive to the delivery of credit, and some people make a lot of money. Warren Buffett and Berkshire Hathaway had cash at that time because they own a little insurance company called Geico, and Geico gets all of their customers to pay in advance, and so they have all this cash from the insurance company kind of sitting around, and they can invest it in all kinds of things. They invested in a company called Goldman Sachs. They sold I think, or they purchased I think something like $500 million of preferred shares from Goldman Sachs, and they in 2007 they were granted 10% dividend every year, and they also had a 10% premium if Goldman Sachs wanted to pay off the preferred shares and buy them back. They had to pay $10 million there as well, and I think it took them about 5 years to pay it off. So there was $10 million dividend payments plus a $10 million premium. And in addition, they kind of threw in some warrants on common shares, and Berkshire Hathaway made about $110 million on those warrants as well. So that was a fairly profitable transaction. That was because they had cash when nobody else did. And so tight credit conditions make it very difficult for you to get credit. And then, of course, as soon as the Goldman Sachs money was received to pay off the preferred shares, Berkshire Hathaway did almost the identical deal with General Electric, with exactly the same, well, essentially the same terms of 10 million or 10%. Did I say 10%? It's not 10 million. It's 10. It was 10%, so it was actually 50 million for 5 years of dividends. So 10% dividends, which is fairly significant. All right, so the credit information that you want to get would be the financial statements, credit reports, bank's relationship, and payment history that you have with the company. Now, if you have a new customer, you can actually calculate the net present value of that new customer. And so the minus V is minus the variable cost. Basically, you have to build the inventory and give it to them, and so it costs you that. And so minus V is the variable cost that you have to pay. Then 1 minus the Greek letter pi here. Usually the Greek people, the people who teach Greek would say it's P, but that is confusing for us English people. So the letter pi, the mathematical letter pi, refers to the probability of default. So here we pay, as part of the net present value calculation, we pay the variable costs, plus we have the probability of receiving P prime, the price. So the probability of default is pi. So in this case we have a probability of default of 15%. We have an 85% chance of collecting and a 15% chance of not collecting P prime, which is the price. Of course, we don't collect P prime until the end of the month, so we pay for the inventory up front and we collect the price at the end of the month, given that they're part of the 85%. And so we're discounting by 1 plus R because it's 1 period from now. R is the required rate of return for 1 period. So in this situation, we've got a variable cost of $50. So we have to pay $50 to build in some inventory, and then they're going to pay us $110 85% of the time, 1 month from now at a 1% discount rate. So the calculation works out like this. We've got a minus 50 plus 1 minus 15%, so 85% chance of getting $110. The expected return is 85% times 110. Discounted 1 period because we have to wait a month to get our money. It works out to $42.57. So that's positive, $42.57. That means that when we add a new customer, we're better off by $42.57. So what would the break-even probability be? Well, if we set net present value equal to 0, and we made pi into an unknown parameter, then in this situation, we break even if we pay for the inventory, and 1 minus pi is the probability of default times $110 price discounted for 1 period. We just solve for pi, and I'll leave that to you as an exercise because I suppose I could do it in like Excel or something, but I don't have Excel set up right now. But if you did the calculation, it turns out that pi would be 54.09. 54.09 is the probability of default. So even if more than half of your customers, 54% of your customers, defaulted, it's still a profitable idea to grant credit for 1 month to the other 46% who are going to pay. Of course, if you can identify the ones that aren't going to pay, you wouldn't sell to them, and the probability of default would be less. But even if the probability of default was over half of your customers, it's still a good idea to sell them one thing one time. Well, what if we have a repeat customer? Well, once again, we have to build them their first inventory. So we have to give them this inventory at the beginning of the first month. It's going to cost us some money. And then we again have the probability of default, 1 minus the probability of default, so this is the probability of actually getting paid. But in this case, 1 month from now, we're going to get P, they're going to pay us P, and then we're going to have to build them another inventory because they're a repeat customer, so we're going to have to give them another piece of inventory for the next month's payment. And of course, this gets done repeatedly, so over and over and over again. So therefore, it's a perpetuity. The value of perpetuity is the cash flow over R. It's essentially the repeated, the infinite number of repeated transactions. So if we use the previous example, and we're thinking about this customer, and we think they're going to be a repeat customer, we have to pay the $50 to build their first piece of inventory. We have an 85% chance of not collecting the $110, but if we don't collect the $110, we're not going to build that another piece of inventory for them. So we also have an 85% chance of building the next piece of inventory. This cash flow happens forever, every month, and 1% is the amount it costs us to borrow money for a month. So that repeat customer is worth $5,050. If we bounce back to the previous one, that one's worth less than $50. This one's worth 100 times as much because of the fact that it's a repeat customer. So a repeat customer is a very valuable thing. And so you will hear the marketers talk about how it's much less expensive to keep a good customer than it is to find a new one. So keep your customers happy, and that's the importance of good customer service, as they point out. Now, it may make sense to actually give credit to almost everybody as long as the variable cost is fairly low relative to the price. So here your markup is $60 on a $50 item, so you've got 120% markup. So in this case, it tends to be quite valuable to give them credit. If the markup wasn't quite as high, of course the value would be less. But in general, a repeat customer is very valuable. A single customer is very valuable. And as soon as the customer defaults, then you don't grant credit again because you know that their probability of default is more than the average of 15%. So, monitoring the receivables. Well, you have to keep track of them. So what most companies do is they actually use, in their accounting program, they have the ability to draft an aged trial balance. So an ATB is one that the finance people call it an aging schedule, but the accounting people call it an aged trial balance, where each of your accounts receivable is ranked according to whether it's on time, whether it's 30 days old, whether it's there's the column that has the total accounts receivable, and then the next column is the current so it's not actually due yet. Then you've got some which are due to be paid, so sort of 30 days old. Then they're 60 days old, then 90 days old, then 120 days old. So the older ones, of course, are the ones that have been in default for some time, and those are the ones that are going to be working really hard to try to collect. And so that aging schedule helps you keep track of the payments which haven't been made. And on average, your average collection period is an average measure of how late your customers are paying. So we've calculated that in the past. Remember, it's the accounts receivable turnover is sales divided by the average accounts receivable balance. And if you want to figure out what the average collection period is, you take 365 divided by that average accounts receivable turnover number, and that tells you about how long it takes you to collect your sales and collect your accounts receivable and resell stuff to them. So monitoring the receivables, if you find some that are not being paid on time, then you have to implement the collection policy. You might start with a delinquency letter, then you might make a telephone call, you might you might pass them over to a collection agency, so the collection agency will send them a delinquency letter and a telephone call. If they still don't pay your collection agency, you might call the lawyer. The lawyer will send them a delinquency letter and a telephone call. And if they don't pay, you have to decide whether or not the balance is large enough to warrant keeping your lawyer involved at the exorbitant fees that lawyers charge. And so that's kind of the process that you would use. If you have determined that you are not going to use your lawyer to sue them, then at that point you might just give up the process and say, well, forget it, it's a loss, we're not going to get that. If the balance is large enough for you to actually continue with the legal action, then you might continue to keep it on your books. And of course, you remember from 253 that when we write off the account, we debit the allowance for doubtful accounts and we credit the accounts receivable, and it goes away, and then we can stop trying to collect it. Inventory management. So that was the discussion of credit policy. Now we're moving on to inventory policy. And inventory is often a large part of business assets, and it's often the major asset that they have. Now, the accounting standards are really fairly small for the inventory section. There's a few discussions of things like lower of cost or net realizable value, and there's some discussion of different kinds of cost flow assumptions, FIFO, weighted average. But essentially, inventory is a pretty small section of the accounting standards, which is ironic because it's a very significant asset. Whereas other things like leased assets tend to be fairly unusual. Not all companies have leased assets, but almost all of them have some kind of inventory. And yet, the leased assets accounting standards. Last time it was actually I saw it in paper. The leased assets standard was something like 50 pages long. So inventory is a significant one, but we've all had inventory in our businesses for so long that everything is sort of generally accepted. And so we kind of know what we're supposed to do with inventory, I suppose. And we don't have to make up new standards for those because the technology and the experience is quite long in our human experience. So the costs associated with carrying too much inventory are offset with the costs associated with not carrying enough. Carrying costs versus shortage costs. You kind of get in the picture now, right? So the costs associated with carrying too much inventory, you have all that extra storage, you're going to have to pay extra finance costs. Costs associated with not carrying enough inventory is lost sales, because your customers are going to go somewhere else if you don't have the inventory to supply it for them. So you want to try to set some kind of optimal trade-off between when you buy new inventory so that you have enough but not too much. So there's different kinds of inventory. Remember from your management accounting class, our manufacturing firm has 3 different kinds of inventory. Raw material, the stuff you're going to make into finished goods. The work in progress, stuff that you are making into finished goods. And finished goods, the stuff you have made into finished goods. So that's what you actually sell. A merchandising firm, of course, buys finished goods as finished goods and just basically moves them around as part of their service to the customer. But for a manufacturing firm, you have to do all kinds of things to actually build it yourself. So it may actually be the fact that your finished goods are somebody else's raw material. So think about if you're manufacturing car parts, There's a large company in Canada called Magna, and they make car parts. And so their car parts go into a car. Their car part, once they've finished manufacturing it, that's their finished goods, and they sell that to Ford or Chrysler or some other car manufacturing company. And that car manufacturing company takes that as a raw material item and puts it into their car, and their car is the finished good. So there are sort of different progressions of finished goods and raw materials in inventory. So different kinds of inventory can be quite different in terms of a number of things, in terms of the degree of completedness, and also in terms of whether you could sell it to someone else. If you're building a particular car part for a particular model of a car, chances are that can't be used anywhere else. So you basically have one target in mind, whereas there are lots of things that are purchased or that are manufactured for the general market, and so you'd be able to sell those to anyone who wants one. Inventory costs. Carrying costs are costs to have extra inventory, have more inventory, more costs. So things like storage and tracking where your inventory is, those are significant costs. If you are a broker, you just contact the supplier and the buyer, and you just tell the supplier to send their stuff to the buyer. So you don't need to have any inventory at all. If that's not you, if you actually have inventory that you either build or buy, you're going to have to take care of it, which means you're going to also have to pay for insurance, security costs. You have to pay taxes for the purchases of the inventory, sort of your GST in Canada, value-added taxes. You are taking a risk of obsolescence. If your technology changes and you have the old stuff, you're not going to be able to sell it for the same price as you expected. Other deterioration, so if it's the stuff at the back of the warehouse that never got sold, it would maybe have dust and might actually have rusted over time, right? All those sorts of things. Or it could get stolen, right? So all of those things are risks of actually having your inventory, and so they're part of the carrying costs. More inventory, more carrying costs. And the opportunity cost of capital is how much you have to pay to borrow the money to finance the inventory. Shortage costs, if you have a very small inventory, that means you're going to have to reorder it a lot as your customers purchase it from you, so you're going to have to pay restocking costs, and there's often a fee involved with frequent orders of small amounts. So those costs, of course, would be part of shortage costs. Of course, you have to spend a lot of time restocking your own shelves if you have very little inventory, so those costs also could be included. Lost sales and lost customers are the big ones, so shortage costs means that you can't actually sell something you don't have. So those would be the lost sales. And so we have to offset those two against each other. So there's actually a model that we can use. We talked a little bit about this in the management accounting class under ABC. Remember what that stands for? Activity-based costing. So this is a way of actually attaching costs for different kinds of cost drivers. And so you can actually use ABC principles to cost your customers, to decide which of your customers cost you a lot of money. So the customers that call you with very small orders and frequent orders tend to take a lot of your time and not make much profit for that time. Customers who send stuff back and expect you to restock regularly, those are more expensive because they cost you a lot. So you can actually use ABC principles to determine which of your customers you want to keep and the ones that you would rather somebody else had. And of course, one of the ways of dealing with that is you charge them more, and if you charge them more, they might go away. Or on the other hand, they might pay for the cost that they cause you. So ABC is a good way of thinking about how the cost structure of delivering goods and services to customers actually affects your profitability. But then there's this economic order quantity model. And the economic order quantity model, EOQ model, compares the total carrying cost of having inventory around with the total restocking costs, and so the carrying cost versus the shortage cost. So here we start with the carrying cost. The average inventory is the average amount of inventory we have, and that's Q. Q is what we're solving for in this situation. And so Q over 2 is your average inventory. So it's divided by 2 because if you started with 0 and ended up with Q, then the average inventory would be half a Q, right? So Q over 2 is the average inventory. And CC is the carrying cost per unit of inventory. So each unit of inventory costs you a certain amount to keep around for whatever your specified period is. Then the restocking costs is the fixed cost per order times the number of orders. So F is the fixed cost per order. So that's like the fee that gets charged every time you reorder. And then T is your total sales for the year. So your total amount of inventory you need for the entire year. And Q is the average number of, is average inventory, as we said before, right? So T over Q is your total sales divided by your average inventory. So the total units sold divided by the total quantity, or the quantity of inventory. So it's not the same as inventory turnover, which is where I was headed with that. So it's the total number of units you sell every year divided by the total number of units that you have in inventory. So this is a measure of the units of inventory, not the dollar size of inventory. So the total cost of having a certain amount of inventory is your total carrying cost of having that level of inventory, plus the total restocking costs of having that level of inventory. So if you increase your amount of inventory, the carrying cost is going to go up, and your restocking costs are going to go down. On the other hand, if you carry a smaller amount of inventory, your restocking costs are going to go up, and your carrying costs are going to go down. So it turns out that we can actually solve for that. And one of the end of the chapter problems actually does go through that process of solving for Q star. And so you can see that in the solutions to the in-class problems. So it works out that Q star, the optimal quantity, inventory quantity, or the economic reorder quantity, is 2 times the total number of units you sell per year times the fee for each order, divided by the carrying cost per unit of inventory, taken at the square root. So here's an example calculation. Our inventory has a carrying cost of $1.50 per unit, and so presumably that's, carrying each additional unit in inventory costs us $1.50 more. The fixed cost to make a new order is $50 per order, and that could be shipping, or it could be actual fees that your suppliers charges you for your orders, or it could be stocking costs, the cost of actually getting it and putting it into inventory, into the records, and into the actual physical warehouse. All of that stuff would be included in the fixed order cost, and the firm sells 100,000 units per year, so that's T. So CC, F, and T. So what is the economic order quantity? Well, it's 2 times T times F divided by CC taken at the square root. So 2 times 100,000 times 50 divided by 150, and take the square root of that. 2582 is the economic order quantity. So when your stock gets down below 2582, you should reorder, and you should order 2582, and then it will be adequate. And so that's what the economic order quantity does. You might want to consider a few adjustments to that number, and so the adjustments might consider things like safety stocks, so how much extra you want to have. So you might want to have, if you have 2582 as your economic order quantity, and you want to have a little bit of extra safety, you could reorder at 3582, and then you've got a little bit of delivery time, and in case you don't get the expected delivery at the expected time, you still have a little bit of extra time to do that. Of course, those safety stocks, the more safety stock you have, the more the carrying costs actually increase. So the question of the economic order quantity tells you the optimal reorder time, but you need to think about, it's not instant. That would be the economic order quantity if you were to receive the new stock immediately. So there's a little bit of risk of doing that. So you need to account for the fact that it takes a little time to actually get it delivered to you. Other things to think about: just-in-time inventory is basically kind of like the brokerage idea, where you don't actually keep inventory yourself, you just get it delivered exactly as you need it. Of course, that's more expensive because that's much more on the ordering cost side. And so the fee for ordering would include the increase in price that your supplier would charge you, because you're not one of their favorite customers unless you actually pay a little bit more. You can actually design this with a software suite designed for materials requirements planning. Not something I know a whole lot about, but the idea of MRP is it actually allows you to do calculations as to what is the optimal economic reorder point. So considering all of these things together. So you should know the answers to these questions, and that's it. Here's the summary of everything that we've learned, and that's it for the chapter. Thank you for listening.